first off, it looks like Kyle had asked, the market's been up quite a bit. I've been long with a married put in SPY and QQQ per the married put technique, the married put approach following the rules in the blueprint. We're going to buy shares of stock and buy a put option. Excellent, Kyle. Now, per the method, do I just keep rolling up the puts? Any reason to stop once the put is past the point where the rolls have made it no cost? And he says, relatedly, if the market fell 10% tomorrow, would you roll your puts down or leave them deep in the money? All right. Fantastic question, all. And Glenn, of course, we'll get to your question in just a moment. So I think I'm going to lump the conversation that I wanted to have in with Kyle's questions. This is probably going to take about 20 minutes because it's going to be about 2 to 3 different segments, mostly 2. Now, what is Kyle referring to? When we approach a married put structure, I just opened a couple of married puts recently, one on Planet Fitness, one on the footwear apparel and sportswear apparel as well. And you would say, why are you doing 2 things in sports in a diversified portfolio? There's a reason why. With the New Year's resolutions coming up, I think that's going to have an effect both on Planet Fitness and on the on athletic footwear and things of that nature. I'm going to open other married puts coming up real soon as well. But in any case, our preferred structure for the married put naturally is we're going to buy shares of stock or an ETF if that's your approach. And we're going to buy an in-the-money put far out in time to control the risk to about a 6, 7, 8% guaranteed, the most we could lose on the position. Now, I don't see any of my positions on the first page. I want to go to the second page, see if any of my underlyings are here. There's Planet Fitness, okay? And we'll use that as just the opening example. I'm going to look back, and we're going to look and see what we could have done maybe a few months ago with SPY for Kyle's example. Talk about what we would have done. Why is he talking about rolling up the put and when you would stop? And then we're going to address some other concepts regarding that Kyle can look into. And then we're going to take a look at some forward-looking concepts as well. But let's take a look at our preferred structure. This is in the married put search. Following the guidance in our full course, The Blueprint for the Married Put Technique, with 13 different income methods that you can use on the position. Our preferred default search is radioactive, sorted by earnings per share growth. Now, right now, Planet Fitness is trading at $99.87. Right now, I could buy the December 105 put for $13.65. Now, why would I do this? I'm adjusting my effective cost per share, my total debit, my break even to $113.52. Well, that's only at December expiration. If I hold this position all the way to December expiration, the stock does not move from its current price. I make no adjustments against the trade, and this is December 2025, remind you, 378 days out in time. And in the worst case scenario, I could only lose 7.5%. Now, Planet Fitness doesn't pay a dividend, of course, so I would also have to accept no dividends, but if they did pay a dividend. But that's the worst case scenario, 378 days out in time. Let's take a look at the profit and loss chart. What are we doing with this married put approach? We've effectively flipped the covered call and the cash secured naked put profit and loss chart upside down. In other words, instead of having a capped gain on a covered call position on a stock that we were neutral to bullish on, we've bought the stock as we would in a covered call and bought the put option, which guarantees that we can't lose more than this 105 price. Even if the stock fell to $20 per share tomorrow, we still have the right to force someone to buy our shares of stock at 105. In this case, that makes the maximum risk only 7.5% of the total $11,352 we invested in the position. Better than a stop order, which is assumed insurance. This is guaranteed insurance. Now, of course, as I'm in a position such as this, I can still sell calls against it. And I could sell the 105 out of the money, get a little bit of premium, continue to knock down this max risk, and eventually, moving and adjusting the put option as well, our second working asset, we can get to a point where we're bulletproof. And bulletproof means that this red area down here, we've lowered the cost basis below our $10,500 guaranteed exit price. We have no risk on the trade and still unlimited upside profit potential. So instead of the capped gain, with still taking on 96, 97, 98% of owning the stock outright, we flip that completely around, and we have a position starting off where we can only lose 6 or 7 or 8%, and we have unlimited upside profit potential. That's the married put in general, the basic introduction. And now, let's go back, and I'm going to open up another window here very quickly for power options, and I want to take a look at where SPY was. Kyle had mentioned he was trading SPY and QQQ repeatedly going through the last year or so. So what I want to do is I'm going to go ahead and take a look here. I'm going to SPY, and I'm going to go just to quotes. I'm going to go to stock quotes. And let's go back to October 2024. I'm going to go back as far as I can. When you're on your trial to power options, you have about 2.5 to 3 months of access to historical data, historical options data, and more. Now we see that SPY is trading at 607.81 right now. Close of today up about $1.15. And we were at 567.80 back on October 7th. Now what I want to do real quick is link to the option chain. And let's go back in time as well on the power options chain. We're going to go back again to October 7th. I want to just look at the put options. Now, right now, the historical data is uploading into the system, so we're interacting with a table that's getting a whole lot of data interrupted into it. And again, the default is I probably would have gone out at least 150, 200 days out in time. Let's go a full year. So on October 7th, I would have probably opened maybe the September Q3, or maybe the December put. I could have used the June, I could have used the August. Let's just use the standard September. Oh, I'm sorry. No, I don't. I want to use December. I need to use December 19, 2025 because it's still open and available. So let's go ahead and take a look here. What puts were available for December expiration on October 7th, December 2025, 438 days away. I want to be slightly in the money. So what I'm going to do in this case is we're going to take the midpoint price, 3 strikes in the money of the 580 strike at 37.94. Okay. Now let me enter this into the portfolio very quickly. So I'm going to go to portfolios. Now I already have multiple portfolios set up, but here's where we are, current radioactive trades. We're going to take a look at that in just a moment. Let's go to setup though, and we're going to call this December 6th. Sorry folks, portfolio. Actually, I hit the tab there. All right, December 6th portfolio. Now, I know I needed to put in, a lot of money. So let's put the $100,000 here to start. We're going to copy that over, and we're just going to put this on October 7th was the date we just looked at for these historicals. Okay. So let's go to portfolios now where we enter our open positions. We're in the December 6th portfolio column. We have nothing entered. We're going to enter in our married put. The stock symbol SPY. We're going to put in just a simple 100 shares. We're going to select our date for October 7th just to keep everything simple. The price that we saw at close was $567.80. I'm not going to include any commission fees on this one. And at the same time, what were we going to do? We were going to buy that slightly in the money at the time, 580 put for December expiration of 2025, now 378 days out, the 580, right? Yep. And the midpoint price at that time was $37.94. All right. Oh, and let's just keep the bookkeeping the same. Let's go to October 7th. All right. So here's the married put I might have entered on SPY. Now, my total cost basis for 100 shares was $60,574. And the stock is just above that. So you'd think, oh, well, your break even was 607.81. I'm sorry. The break even, would be 605.74. We're at 67.81, so you're only making $2 or $200. The put doesn't go to zero. We have a lot of time value in the position. When we opened this trade at 567, the 580 put was $13 in the money. We paid $24 of time premium. We're still keeping $21 of that. We've made $4,000 on the security and only lost about $1,600 on the stock. We would have done other adjustments before this, as Kyle mentioned. We could have sold calls against it. We would have been collecting the dividend. We likely would have crossed one dividend in 60 days, maybe depending on the time frame. But we could have been doing different income methods, weekly or monthly, following the rules in the blueprint, or using this second working asset as a way to roll or adjust the put. Now, we're going to show a quick example of rolling up the put right now. And then using income method number 4 in the blueprint, one of the 13 income methods, which will probably bulletproof this trade at this point that we've only been in for 60 days. It's going to be close. My maximum risk, remember, was low. It was only about 5.6% on the trade. And we didn't look at that. Let's look at the profit and loss chart. I apologize. I saw it with the time value. So it was 4.2%. The maximum risk, the worst case scenario, December 2025 expiration, if SPY was below 580, was 4.2%. I have a whole year to generate income, collect dividends, cut this risk down from 2574 to potentially bulletproof status. Kyle said during this year he's been in QQQ and SPY. As the stock has been moving up, what he's been doing is rolling the put up with the position, as discussed in the blueprint. Income method number 4. Right now the stock is at 607. Now we saw we had $21 still of value in our 580 put for 2025 December expiration. What I'm going to do is essentially just change time value. We're going to take advantage of the at the money bell curve. So when I bought stock at 560, I bought the stock at 567, my 580 put was over here. What the at the money bell curve is showing us is that the options on any option chain that are right at the money always have the highest time value. Using the put as a second working asset, there's 4 income methods that you can use to manipulate this protective put option. It's not just put it on and use it for insurance. We're taking advantage of the at the money bell curve and the time decay curve of the options. That's why we're starting so far out of time. We're putting time and moneyness in our favor. So we bought the stock. We bought a put option up here. Then eventually the stock crossed 580. So now our 580 strike at that time had the highest time value of all of the options for any expiration. Well, our expiration in December, but any expiration, whether it was October of this year, whether it was November of this year, whether it was December of this year, or December 2025. So right when the stock started to move above that, we might have rolled the put first up to the 600 strike. And if we're at the 600 strike here, when the stock was at 580, we would have been on the lower end. But now SPY is at 607. So where's our new put? It's at the highest time premium, near range, so we might roll it up again. But let's take a simple look. What is the advantage of rolling up the put? I've lost money on this put. We already said it was about $21. So we've lost about $16, $13 on this put. We've gained much more on the stock. We're still in a positive delta position, as you can see by the profit and loss chart. What's the advantage of rolling up the put? Let's take a look. Let's go to the December 2025 series. Using the view options link, we're just going to do a manual roll here. December 19th. This is also the profit and loss chart with the custom spread tool where I would adjust positions. So sorry for the scrolling. Our 580 put's already been added. So I'm going to click it again. And let's go up to the 615 put. Now, what am I doing? I'm going to sell this put that I own, already accounted for in my cost basis, for a midpoint of probably 21.54.55. Then I'm going to buy a 615 put for 31.40 or so. I'm adding a debit to the position, right? We're going to add a debit of roughly about $10 to this trade, because I'm selling here at 21x, I'm buying here at 31x, so we're adding $10 to our cost basis. Why would I want to add to my cost basis? Because I'm guaranteeing a higher payout of $35. I'm paying 10 to be guaranteed to get 35 higher back, from 580 up to 615. All right, so we've added those in. Let's scroll down to our custom spread calculator here, profit and loss chart. We're going to simulate selling the 580 just at midpoint, and we're going to buy the 615. Oh, just missed it. So here we are now, pretty much at a bulletproof status with protection out for another 378 days. This doesn't count for any dividends or anything else we would have received. Okay, so we have a no risk position guaranteed for 378 days, still opportunities to use 13 other income methods as the stock moves up or down. Now let me use a fake number very quickly. I just want to illustrate this for Kyle's point. Kyle, you said that you've been in these SPY and these QQ positions for a while, trading them for these years. You've been this last year or so. You've rolled up the put using income method number 4, and you're likely in a good bulletproof status, meaning you're guaranteed a 5, 6, or 7% profit. SPY continues to move up in price. What would you look to do in order to keep rolling up the put, or when do you stop? The answer to that question is that when you've felt that you've reached a bulletproof status that was within your target range for the length of time you've held the stock. In other words, my target goals for the Mary Put technique is to realize about a 1.5%, 2% return, realized or unrealized, per month. And I've relatively got that. Beat the S&P most years. Ernie's been beating the S&P for the last 4 years, just buy and hold S&P and QQQ, I believe, for the last 4 years with his Mary Puts. He's got several positions that are bulletproof to 12%, 15%. I think one is even bulletproof to 25% or 30%, but he's been in it for about 2 years. But that's fantastic. He's guaranteed a profit of 33% in 2 years of trading on that position. He still has a higher liquidation value right now. Why is he still in it? Because he's still bullish on it and he's still making the adjustments. Let's use a fake number. All right, this is fake. This didn't happen. But let's say I bought this on October 7th, remember? So I've been in this for about 2 months. Exactly. And that's as far back as the history went, Kyle. So I've been in this for 2 months. If my target is 1.5 or 2% per month, fake number, I apologize. But let's say that I actually got $28 when I sold to close my 580 put. And then I paid $31.45 for this. Okay, so, it's not realistic, but just let me show you. This would have happened, could have had these numbers once SPY, went up above 580 to 582 or 583. If we rolled up to the 590, then it breached 590, we went up to the 600, then we went up again to about the 615. Okay, not as high as I thought, but we might be something here that's at a 1% bulletproof status. That's behind my goals. I'd like to be at 2%. But again, I might have sold some calls, done some other things. Let's say we collected a dividend, whatever. But let's say we knocked our cost basis down with some of those other income methods down to 560. In the last 2 months, we generated $7.80 of premium dividend, selling a couple of calls. Where am I at right now? Right now, if that was the case, I'd lowered the cost basis. I got this price. I know it's fake. But in 2 months, I've got a position that's bulletproof to 2.3%. Close to the 1.5% I was looking for of realized profit. And then going forward, I still have unlimited upside opportunity. The answer, in my opinion, to your question is keep rolling with income method number 4 until you've hit a point where you've met your target goals for the position as far as bulletproof status goes, even though I'm still 378 days out in time. I would keep doing that. But once I hit a certain point, Kyle, I would likely stop. And I would likely look to maybe just use the other income methods, generating premium, income method number 1, income method number 6, or other strategies. Because if I can keep rolling up the put and going from 2% bulletproof status to then 4%, even though I'm increasing my cost basis, 5%, well, then what happens when the market crashes? Number 1, I've locked in more guaranteed profit in the worst case scenario. Number 2, I have a much higher strike put that I can manipulate the opposite way that's going to relate to your second question in just a moment. Now, all that being said, that is my approach and that is my opinion. What I want to do now is, I'm not sure if it's here, but we're going to take a look at it. I'm going to go to our YouTube channel. You're not seeing it yet, of course. Let me just get over there and navigate to it. Okay. All right. And so here we are. I'm sorry. We're at the Power Options YouTube channel. Some of our recent presentations here about the married put, keeping her married bulletproof. What strike should I roll the put to? We're talking about income method number 4 here. But let me do a quick search here, Kyle. And the search I want to use is on our channel. We're going to use a little, I apologize. We're going to use a little magnifying glass here. It says, I'm going to use when to stop. I thought I made this public, but maybe I didn't. There it is. It's from 4 years ago. When to stop using income method number 4 and other concepts. So we sort of break down the risk adjustment on a chart, much better plan, actual prepared presentation rather than on the fly here, Kyle. Is there a certain point to stop using income method number 4 on a momentum stock? Well, first, we address income method number 4, which we just showed you guys. But then we talk about a specific example of when I might consider to stop using income method number 4 and focus on the other income methods as well. Okay. And Kyle addresses an issue here. I'm sorry, was this Planet Weary? I'm sorry, wrong view. Give me 1 second. There we go, SPY. Kyle says, at least with SPX and QQQ, it's a longer-term retirement savings position. The only downside is the debit on the roll is kind of an opportunity cost because it's capital I can't deploy. What did we do here again? Now, this was the fake example. Let's go back to the real example. What was our... I'm sorry, let me go ahead and submit that. What was our real price? And you can't deploy buying stock, but I'm generating a return on the funds used for the debit because the net effect, as you point out, is positive. See, that's the key to remember. You're right. In this case, with just 100 shares, Kyle put out, in my example, to almost get to bulletproof status. Oh, this one is. Oh, because I lowered the cost basis with other income methods. Not at the 567, it's the 560. That's fine. But Kyle got to 2100, 2156 back, and paid 3,144 for one contract to roll this put. That's the debit. He is paying a debit. Income method number 4 is pretty much the only income method that's done at a debit. Paid $1,000 to do this adjustment. 10 points to gain 35. Now, Kyle's comment is very valid. And it's a concern of a lot of investors. You're used to generating covered calls. Hey, I've been generating premium week by week or month by month. Why would I buy a 6 to 8 month output to ensure my position, guarantee it, and leave the upside open? Why would I roll the put and add cost basis? Why would I buy the put to begin with? Because how many covered calls do you have where you bought a stock, say, at $56 that you were pretty sure was going to go up to $60, $60.70, $61, but actually went to $45? Did you follow your stop order? Or did you follow the psychology of investors saying, oh, it's going to come back up and drops from 56 down to 53. No, it'll come back up. Down to 50. Oh, it's going to come back up. Down to 47. Oh, it's okay. I can still sell cheaper calls here. I can sell a 30-cent out of the money 50 call. I don't want to do that because now if the stock moves up, I'm going to be locked into a loss if I get assigned at 50 because my cost basis was 56. I've only generated $2. With the 58 put, you were guaranteed to only lose $3 or $4 on the position. Now it's down to 45. Oh, it's going to come back. I'm going to try to keep selling some out of the money calls. It's going to come back. I'm getting 20 cents or 30 cents. At this point, you would have only lost that initial 4%, 5% on the trade, as opposed to being down 11 points on a $56 stock and only taking $2 or $3 back for covered calls trading over those first 2 months. But once I'm in that, that's why you add the debit, because it's guaranteed insurance. That floor is set for you at the bottom. Why would I add a debit to roll up the put? Put $1,000 into this trade. He put $1,000 into this adjustment, our fake adjustment I put in. Selling to close the December 580 put, December 2025 for 21.57, and buying to open the December higher strike 615 at 31.45. Paid $1,000 to guarantee $3,500 back. So you mentioned, Kyle, it's capital you can't use. What? Snarky remark, and I'm not trying to be snarky, but the other look at it is that how often do you invest $1,000 in the stock market or in your options trades and get $3,500 back? That's the power of income method number 4. Where else can you get a 3 times return? That's right, Kyle. So Kyle sees it. I think you guys see it too. That's why I use income method number 4. It's one of my favorite ones to use. It's because of that payout when the stock goes in your desired direction to move it up. Because in what other area of the market am I more confident in that I can pay $1,000 right now and get $3,500 back? That's why I love income method number 4. Yes, it's adding to my cost basis on the total position. Yes, I'm adding a debit to it. But remember, I'm getting, the way options work, I'm getting a higher guaranteed payout than the debit that I put in. That's why income method number 4 works, with help of the ATM bell curve we touched upon a little bit.